So next, we are almost halfway through our marathon, and I'm delighted to welcome Deepak Bhholusaria for our next important session on TDS and TCS provisions. Deepak Bhholusaria is a partner at DAKSM Co LLP. He's a commerce graduate and a fellow member of the ICI. Deepak served the Taxation Audit Quality Review Board of ICI for 23-24 and is an elected member for the Executive Committee of the Sales Tax Bar Association. With 25 years of experience, Deepak is seasoned professional, author, faculty member of ICI, and a speaker. He has presented on national televisions, industry forums, and various branches of ICI and ICSI. ICI has even recognized his contribution as a speaker over the years. An IT enthusiast and a YouTuber, he's also a life member of a major tax and C association in the country. Hi, Deepak, how are you?
I'm good, Ridhima, and good afternoon to everyone.
Very good afternoon from everyone's side. Yeah. So without further ado, the session is now all yours. Thank you so much.
Thank you, Ridhima, and very welcome to everyone here on the Taxman's Budget Marathon 2024. I'm privileged to be here amongst all of you. So without wasting much of the time, let's deep dive into the topic itself. Let me share my screen, please. Is it visible, Ridhima?
Yeah, it is. It is.
Okay. So, and my voice is also audible?
Perfectly clear.
Okay, so I believe I have approximately 30-35 minutes to speak, and we can have a 5-minute session for question and answer session, right?
Noted. Yes.
And I believe all the audiences, I mean, the participants will be putting up their question only through chat window, or is there any YouTube live streaming also?
So it is being broadcasted live on almost 6 media platforms.
Okay.
So all the questions would be curated, will be directed to me, and I'll be asking you from other platforms. They can put it in the comment box there.
Thanks a lot. Thanks a
Thank
lot.
you.
So already I have been introduced by Ridhima. So I qualified as a chartered accountant in 1998. And I'm into practice for the last 25 years. And our firm's name is DAKSM Co LLP. We have various offices all over India. And these are the topics which we are going to cover today as far as TDS and TDS TCS part is concerned, starting from amendment in section 192 and going to then what are the changes in TDS, various sections of the TDS. And very interesting section which they have introduced this year is TDS on payment to partners of firms. I know a lot of questions and a lot of doubts are there in the mind of the people. Then there are many changes which are related to the administration part of the TDS and TCS. There are changes as far as penalty is concerned, time limits for filing of your correction returns are concerned, and so on and so forth. So we will be dealing with each and every point in detail, one by one. So let's start with section 192 amendment. So you see, till now, if I'm an employee, and obviously I'm earning certain salary from my employer, and my employer is under an obligation to compute my TDS liability under section 192 for the whole year, right? I file a declaration throughout the year, and at the end of the year, I provide proofs. Obviously, if it's a case of a new scheme, then obviously those proofs are little less now. But in any case, employer is under an obligation to compute and deduct the TDS. Now, by doing so, there may be a certain situations where I am also earning certain other income. Let's say I have an interest income, or maybe I'm employed with employer for, let's say, employer B. And prior to that, I was employed with employer A for a part of the year. So that salary, that part of the salary, I'm also supposed to tell my present employer. And taking into account that salary, my employer will recompute my entire year's tax liability and deduct the TDS. And obviously, since I have already, I have given, I have disclosed the salary from employer A to employer B. So employer A might have also deducted some kind of TDS, right? So employer B is also under obligation to consider the TDS which has been deducted on salary from employer A. This is one example. Another example could be that I have, let's say, interest income. And on interest income, we know generally only 10% TDS is deducted. Or there may be a situation where TDS is not at all deducted, right? And I am into slab of 30%. So there is a gap of 20%. So in order to fill in that gap, either I need to deposit my advance tax, or I can simply tell my employer that, look, you consider this salary, this salary or any other income, and also consider whatever TDS has been deducted on this income, and whatever is the balance liability, it may be deducted by you through Section 192, and employer used to do that. Now there were certain issues therein also. First, only income could be considered by employer, not losses. Let's say there is a loss, maybe in certain head, which employer is barred to consider, and that position still stands. Loss cannot be considered even after this amendment. There may be situations where I have TDS or TDS in some other sections also. Let's say if you see if a particular income has not been considered and that income actually has a loss, then since that income has not been considered or that loss has not been considered, if there is any TDS which is related to that particular source of income, that was also not considered. So the law said that income and TDS thereon. So there has to be a linkage between the income and the TDS. First. Second, TCS was not allowed because TCS is not income. Let's say I have purchased a car, and on that car TCS has been deducted, collected from me. And obviously, well, I'm filing my income tax return, I need to take the credit of that TCS, and ultimately there will be a situation where I am getting a refund from the department. So again, that TCS credit was not allowed. Now, two things have changed. First, obviously you can disclose the income. Second, any kind of TDS which has been deducted somewhere else can also be considered. And second, if there is any TCS which you have deposited or it has been collected by some collector, then obviously that credit is also now allowed to you. So these are two very major changes, and it's very beneficial to all the employees. If we look at Section 193 basically talks about interest on security. There is 192A, 194A, which is interest on other than securities, and there is Section 193, which is TDS on interest on security. And within Section 193, there are certain exceptions also, wherein even though the primary provision of 193 says that TDS has to be deducted on interest on security, but there are certain exceptions therein also. And one of the exception which has been provided in Section 193 is that if there is an interest on central or government securities, say for example, treasury bill, I take an example, right? If there is an interest which is paid on central or state government securities, by mistake I have only mentioned central or government security. Basically, it is central or state government securities. So if there is any interest which is payable on state or central government securities, as of today, no TDS is required to be deducted except for saving bond of 2003 and 2018. So these were the two only exceptions, meaning thereby, if any interest is payable on saving bond of 2003 and 2018, then TDS provision shall still apply. Now they have changed this provision, whereas not only 2003 and 2018 are still retained, they have now also added floating rate saving taxable bond. Basically, if you go at RBI's website, these floating rate taxable bonds are issued. You see, generally, the state government or central government securities are issued at a fixed rate of interest, but there are certain market linked saving bonds also which are issued by RBI. So on those bonds, if any interest is payable, even then TDS shall be deducted. Not only that, now there are three entries which are mentioned in the 193 itself. There may be a situation in future where some other securities are required to be notified for the purpose of Section 193. So now the government has taken the power to notify such security rather than amending the Section 193 again and again. Now simply they have taken the power in their hands itself, and this provision is effective from 1st of October 2024. Now going ahead with the changes in TDS rate. So a lot of sections, they have actually reduced TDS rates. So say for example, Section 194D, payment of insurance commission, right? From 1st of April 2024, instead of 5% TDS on payment of insurance commission, right now it's 5% under section 194D, it shall be reduced to 2%. And since it is commission, so similarly under section 194H, the TDS rate shall be from 5% to 2%. If you remember, earlier the TDS rate for commission used to be 10% under section 194H. Then they reduced that number from 10% to 5%. Now, this number has been reduced from 5% to 2%. Similarly, commission again on sale of lottery, again 5 to 2%. Payment in respect of life insurance policy from 5% to 2%. Then 194 IB, wherein if I am an individual or HUF, I am paying any rent more than 50,000 rupees per month, then at the end of the year or at the end of the term of lease, I am supposed to deduct TDS at the rate of 5%, right? Now, instead of 5%, that rate of TDS has been reduced to 2%. Similarly, section 194M, wherein if let's say I have engaged some professional, I'm talking about a situation where 194C is not applicable, 194J is not applicable, 194I is not applicable, right? I'm talking about those situations. I will be dealing in this part in the later part of the presentation also. There is one particular slide on this issue. So again, therein the rate of TDS has been reduced from 5% to 2%. E-commerce operators. Now, why the question is why it's from 1% to 0.01%. Again, the genesis of this change is in section 194Q and 206C1H, right? Therein, for sale of goods or for purchase of goods, the rate is 0.01%. Even though, please appreciate, 194O does not cover only and only goods. Even supply of services through e-commerce operator also attracts 1% TDS. But they have now reduced it to 0.1% only. Similarly, in case of any repurchase of units by the mutual funds or UTI, I mean, till now, the rate of TDS was 20%. Now, from 1st of October 2024, it is going to be omitted at all. So, no TDS as far as repurchase of units by mutual fund or any or UTI is concerned. So, it's again a welcome change. So, all these provisions are effective from 1st10/2024. Please appreciate that all these provisions are procedural in nature. So, that is why generally in the past we have seen either the rate of TDS are changed from 1st of October or from 1st of July, right? Since the budget is announced in the month of July, so practically it is not possible to change the rate overnight. So instead of that, they have changed it from 1st of October 2024. But traditionally, we have seen that the rate of TDS are generally changed or increased or decreased as the case may be from 1st of July at the after the completion of one quarter, because by that time budget or finance bill we call it, it becomes an act, and that is why it is implemented from 1st of July. But since budget is late this time, and that is why the implementation date is either from 1st of October or 1st of April. So 194 IB, I have already explained this part. Similarly, 194M. So 194M basically covers three parts basically. You should be an individual or HUF, and you are not supposed to deduct TDS under section 194C, H or J, or in other words, the amount you are paying to your payee shouldn't be covered. There may be a situation that I'm a businessman, right? I'm a businessman. I'm making payment for my business or for my personal use. So if I'm making payment for my business use, obviously 194C shall be covered. And if I'm making payment for my personal use, then 194H shall be covered. So if I'm not wrong, the threshold limit is 50 lakh. So in this case, if you are making payment for these nature, so these are parameteria with 194C, 194H, and 194J as far as nature of payment is concerned, then in that case, I'm supposed to deduct TDS at the rate of 5%. No, now it is 2%. So now it is 2%. And obviously, there is a separate challan cum return for section 194M. You are not supposed to file 26Q for these, right? The e-commerce operator, I told you that the genesis of this change is in section 194Q and 2061H. So now the rate of TDS from 1st of October 2024 is only and only 0.1% rather than 1%. You see, if I'm making taking any online transaction, offline transaction, that the rate of TDS is only 1.1%, or whether it is a sale of goods or whether it's a purchase of goods, as the case may be. But now to bring parity between the offline transaction and the online transaction, now the rate of TDS or TCS, as the case, TDS basically is 0.1% only. Now we were listening to other speaker as far as capital gain is concerned. So the impact of changes as far as capital gain on financial assets is concerned, we can also see those impact of those changes in section 196B as well as 196C. So in case you see till now, if there is any capital gain or any income from mutual funds, right, from units, so the rate of TDS used to be 10% for units. So till 22nd of July 2024, the rate of TDS shall remain, I mean, it used to be 10% only. Because of change in rate for capital gains, for long-term capital gain on section 112A you talk about, or any other section you talk about, or 112 you talk about, the rate is 12.5% now. It's flat, 12.5%, right? So accordingly, consequently, the changes have been made in 196C now. So that rate of TDS on units as far as capital gain is concerned, but as far as dividend is concerned, it is still 10%. But on case of redemption, it may be a case of redemption basically. So if it is a case of redemption, then the rate of TDS will be 12.5% for all those units which are covered by 196C. Similarly, if the units are covered by section 196C, the rate of TDS is 12.5% instead of 10%. So only the thing is that both 196C and 196B covers different assets, different financial assets basically. But as far as rate of TDS is concerned, it is same. It is 12.5% on capital gain, long-term capital gains. Now, this is a very, very, very interesting section they have introduced. And this section has been introduced from the 1st of October 2024 itself. So let's say I am a partner in a partnership firm. Obviously, what kind of income I earn from my partnership firm? It can be a salary or remuneration, whatever name you call it. You have to see the substance of the transaction rather than the nomenclature which you are giving it to it. So it can be salary, it can be remuneration, right? It can be a commission, right? Commission in the form of percentage of profit of the firm, or it can be in the name of, or it can be in the form of bonus also, or it can also be in the nature of interest on the capital which I have deployed in my firm. And on top of that, I shall also be eligible for profit from the firm or maybe losses from the firm. Now, what they have done is they have introduced TDS on all these kind of payments at the rate of 10%. So at the rate of 10%. So similarly, like any other section of TDS, so the provision is at the rate of 10% at the time of payment or credit, whichever is earlier. Now, this is effective from 1st of October 2024, and threshold is also 20,000, right? So there are a couple of issues. It's a first time provision. There can be a transitionary issues also. First, let's say till 30th of September 2024, I have already credited partner's account. I am a firm, right? The responsibility to deduct is on the shoulders of the firm. I have already credited partner's account by, let's say, 50,000 rupee on account of. You see, it is very important that on what account the account has been credited, right? It can be credited on account of salary. It can be credited on account of remuneration, commission, bonus, interest. and also profit. But you see, profit is only credited at, generally it is only credited at that end of the financial year. So I'm not taking that situation. I'm taking a situation on 31st of September 2024. Till 31st of September 2024, I have already credited account, maybe by on account of salary or maybe on account of interest. Now that amount is paid in 1st of October 2024. So let's say till September 2024, I have credited an account by, let's say 70,000 rupees, right? And opening balance, let's extend this example. Let's say on 1st of April 2024, the opening balance was 1 lakh of rupee. Till 30 September 2024, I credited the account by, let's say, 60,000 rupee in the form of salary, not even in interest, in the form of salary. So what should be the closing balance as on 1st of October 2024? It should be 1,60,000 and it is payable to the partner. It is payable to the partner. So now on 1st of October 2024, I have made a payment of 2 lakh of rupee. So the opening balance was 1,60,000. I have made a payment of 2 lakh of rupees. The question is, on what amount should I deduct my TDS? Should it be on the amount of 2 lakh or should it be on the amount of 40,000 only? Sir, since the provision is applicable only and only from the 1st of October 2024, so the first 1,60,000 shall be excluded from this payment, So 1,60,000 should be excluded and only on the TDS should be deducted on the 2 lakh of rupee. Now again, there may be a situation to understand now this 40,000, this extra payment of 40,000, is it in the nature of interest, salary or what? You see, in my particular example, already I have exhausted the balance itself. So what is remaining is the payment of 40,000. So depending on the facts of the cases, it may happen that this payment is on account of capital, right? But since there is no clarity, even though I would expect some circular from the department on this particular issue also. So prima facie, it appears that this payment of 40,000 is on account of salary, interest, or maybe a commission. Generally, it is, and there may be a situation also that during the year I am withdrawing the amount from the firm, but the payment, the credit entry of salary or interest is already made, is only made at the end of the financial year. Let's take that example also. So until 1st of October 2024, there were no credits in the bank, in the account. And whatever credits were there, these credits were on account of extra capital introduced by the partners. So extra capital introduced by the partner. So let's say on 1st of April, the balance was 1 lakh of rupee payable to partner. During the financial year, partner introduced some amount of 2 lakh of rupee. So on 30th of September 2024, the outstanding payment is 3 lakh of rupee. Now during the financial year, partner made certain withdrawals also. So there were certain inwards, there were certain withdrawals, there were certain inwards, there were certain. So we have to figure out that this payment which is being made to partner, is it on account of salary or is it on account of the balance which is already lying in the account? So what I will do is I will apply the FIFO method, right? So let's say on 1st of October 2024, the balance payable to that partner is 5 lakh of rupee. I am taking an example. In the month of October, for first 15 days, I made a payment of 4 lakh of rupee. So this 4 lakh will be adjusted against the 5 lakh which is already payable to the partner. So there is no question of making a payment on account of salary, remuneration, commission, and so on and so forth. So still 1 lakh rupees payable to the partner. So no TDS. Right? On 16th of October, I made a payment of 3 lakh of rupee. So 1 lakh is already outstanding. So 1 lakh is registered there. So 2 lakh I have extra paid. On 17th of October, partner introduced 3 lakh rupee extra. So 2 lakh extra was first paid and then 3 lakh was introduced. So net balance now is again 1 lakh. So the question now will arise, should this amount of 2 lakh be considered as paid on account of salary remuneration, or should it be considered on account of extra withdrawal by the partner? So this is one particular area where I believe clarification should be issued by the department. Can we put a clause in partnership deed stating that the salary interest to a partner shall be calculated till September of following year and deducted tax in that year? Sir, I can't catch your name. Let's say your financial are prepared for 31st of December, March 2024. The question is, while filing your income tax return, won't you be computing your book profits and asking for the deduction of salary? So can you say that I have credited the account only in September, though this salary is pertaining to 31st of March 2024, or can you claim the deduction? I don't think so. I don't think so. So you see, we need to bring in the discipline now to, you see, as far as salary part is concerned, generally there is a clause in the partnership deed that the salary should be, the salary should be computed, or the remuneration shall be computed per month so and so, and subject to certain limits. This is the general clause I have seen in as far as partnership deeds of generally firms are concerned. So those clauses shall also come into play. So if there is, if you put in the clause that it shall be credited in the account in the next financial year, so how can you claim that deduction? So there are issues so my suggestion is that we should at least prepare two accounts as far as partners account is concerned, even though 194T clearly says any account of partner, it is immaterial whether account is by the name of capital or by the name of current account. So what I will suggest is that you should prepare two counts, still two counts. One is related to capital, where only the amount introduced by the partner and the amount withdrawn by the partner is concerned. And there should be a current account where all salary, remuneration, bonus, and interest should be catered. So if let's say partner is withdrawing salary every month, so that amount should be debited to the current account. Again, it is only for the administrative convenience. I'm not saying that law would be qua capital account or qua current account, because law is very clear. You see, generally in other sections, the concept of suspense account is there, but as far as 194T is concerned, there is no concept of suspense account. But they have clearly said that any account, whether it is a capital account, whether it is a current account. So for the discipline purpose, I will suggest that you should maintain two set of accounts, one only and exclusively for capital. If partner is introducing capital, so that account should be debited as till the time there is a balance in there, so any withdrawal should be debited to capital account, unless and until you have an issue that if I withdraw capital from my capital account, I may be entitled to less interest on my capital. In that case, you should go to current account, and then you should bear the 10% TDS also. There may be a situation, friends, that let's say I have made a payment of, let's say, 5 lakh of rupee, but at the end of the year, I see that the salary which is allowable to my partner is only 4 lakh. So that also will create a certain situation where, even though the payment of TDS is on a higher number, but actual amount which is allowed to that partner is on a lower side. So in that case, the probable solution could be that you amend your TDS return, but the only thing is again, how will you justify that even though you are paid 5 lakh rupee, but at the credit is there, but at the end of the day, it is the extra payment which you have paid. It's like an advance to the partner. Don't we deduct TDS under section 194C or 194J on advances also? Yes, we do. Similar kind of principle shall also apply here. So I think this question can be closed. If there are any other additional question on this particular issue, I would love to answer those questions also. Okay. So I believe there are no more questions. So again, the lower deduction certificate or lower collection certificate, which is issued by the AO under section 196, 197 or 206C, subsection 9. Now they also cover section 194Q or section 206 in its ambit. Till now, as far as sale of goods are concerned, for that, even though the rate of TDS is only 0.1%, please appreciate the rate of TDS is 0.1% only, but still there are certain situations where even though the rate of TDS was such a low, but a lot of people were under losses. So in order to cover that particular section also, the section 197(6), 197 and 206C is being amended to include within its ambit those section also. So now if you are a purchaser or a seller of goods, then you can obviously after 1st of October 2024 file form 13 and you can obtain a low deduction certificate for that. Because generally I have seen that as far as rate of 10% is concerned, a 0.1% TDS low deduction certificate is issued, but already it's 1.1%. So practically, I don't see any situation where a zero rate TDS LDC would be issued, even though law doesn't bar you to issue 0% LDC. But practically, they always issue LDC with some certain kind of rate. So maybe 0.01%, at 0.01%, they may introduce. Again, from 1.1% to 0.01%, it could be a substantial amount. But it is applicable only from 1st of October 2024. Now, there may be a situation where, let's say, I am earning income from outside India, right? Let's say 100 rupee. And on that 100 rupee, 30 rupee TDS has been deducted. Right? So, what is my income? It is 100 rupee. What is the TDS deducted? 30 rupee. So, the question is, what amount of income should I offer? And should I claim FTC or not? So, as far as 198 is concerned, if you look at other things also, it very clearly says TDS deducted is also income earned. So that if let's say it is a case of 70 rupee, you shouldn't offer 70 rupee as income, right? And you also claim 30 rupee as TDS. But as far as foreign income was concerned, it was happening so. People were, because of definition in section 198, people were offering only rupees 70 as income, and at the same time they were also claiming FTC for that 30 rupee. So there was a double loss to the government. One hand, you are offering income of only 70 rupee. It means that on 30 rupee, government is collecting no tax. And at the same time, you are also claiming FTC. Now they have amended section 198 to tell us that in case you're also claiming rupee 30 as an FTC, in that case, this entire 100 rupees shall be treated as your income. But in case you are not claiming this 30 rupee, as far as foreign taxes are concerned, you are not claiming this 30 rupee as FTC. In that case, you can clearly claim only 70 rupee as your income. And this change in section 198 is effective from 1st of April 2025. So how much time is left with us, Ridhima?
So we have good 5-6 minutes more.
Okay. So again, I have a lot of slides. Let me quickly rush through them. Okay. So you see, till now, there was a time limit to file your original TDS statement or TDS return or TCS return, which we generally call it. But there was no time limit per se for filing of correction return. So now they have corrected this anomaly. So there is a period of 6 years, both for filing of original return as well as filing of correction return within 6 years from the end of the financial year, from the original due date of filing return, And this, obviously, this limit shall be qua each return separately. For 26Q, we are supposed to file 4 returns. For 27Q, we are supposed to file 4 returns. And similarly, we are supposed to file 27EQ or 24Q as the case may be. So far, 4 separate returns, time limit would be separate. At least for 3, for first 3, it could be combined time limit. because quarter 4 TDS return basically the due date of the quarter 4 TDS return falls in next financial year. So effectively we have an extra 1 year for that return. But now there is a parity between original return, time limit of filing original return as well as correction return. Now, this is a very, very, very interesting amendment. If you remember, earlier it used to be that if you don't file your TDS returns or TDS statement within a particular time limit, you are supposed to pay a penalty of rupees 200 rupees per day, right? We all know that no penalty can be levied automatically. You see, you need to give a chance to the filer that why TDS return or TCS return was not filed within the time. What were the reason behind filing of that late TDS returns? But in my experience, rarely that penalty was levied. So instead of penalty, they introduced section 234E. Years back, they introduced 234E, whereby now instead of penalty, they said late fee for filing of TDS return, right? But it doesn't mean that the penalty was altogether removed from the statute books. No, it was still there. But the penalty was after a expiry of 1 year, from the due date of filing the return, right? Now, please appreciate that the date of filing or income tax return under section 139, now it has been gradually reduced only to 9 months. Earlier it used to be 2 years also, right? For original return or for revised return. Now it has been reduced to 9 months. So instead of 1 year, reducing it to 9 months, they have straightway reduced this time limit for levy of penalty to 1 month only. 1 month only. I believe it's a very, very, very harsh provision now, right? At least the reason you have given is that because of 139, a reduction of period of 139 from 1 to 9 months, there are a lot of issues in processing of your income tax return. So my humble suggestion is that instead of reducing it only for 1 month, it should be linked to 139 also, because you see, I have seen practically that while doing audit, we have seen that certain TDS which were supposed to be deducted or certain TCS which were supposed to be collected were not done so by the auditee. So on our recommendation, or maybe because of 3CD, now they have deducted the TDS and also filed their income tax, TDS returns, TCS returns. So it would be a very harsh provision on them, because in the month of September, now they have got to know that, okay, this TDS or TCS was supposed to be deducted in quarter 4. Now they are filing it. But the moment they are filing it, not only they are liable to pay late fee, now they are also liable to pay penalty also. They are also liable to pay penalty because 1 month period has already lapsed. 1 month period has already lapsed. So I believe this particular provision is a little harsh on the, and on the very pretext that you had introduced this late fee. Now it is also there. It is similar kind of situation when STD was introduced, saying that, okay, we are exempting long-term capital gain on shares, and introduced STD. Now STD is also there. Long-term capital gain is also there. Not only that, you have also increased the rate of long-term capital gain. So similarly, is a situation here also. You have introduced penalty, late fee of 200 rupee per day. And on top of that, I'm also liable to file my return within 1 month. If I don't do that, there would be a penalty. Ridhima said that there is an applicability. Let me check, Ridhima. I can check and get back to you on this, whether
Sure,
this is
sure.
applicable from
Sure, sure.
1st of April or 1st of October. I
October.
believe I read it 1st of October only, but still let me check that. No
Yeah,
problem.
because we have some
Maybe
similar query from the day.
I might have read it wrongly. But all the principle would remain same. Only the date
Yes,
might
yes,
differ.
yes.
No problem at all. I may be wrong. Anyway, so so this was what was the provision? Okay, just a sec. So the ambit of section 200A is also the title, I think, is incorrect, but the provision is correct that not only deductor, there may be a situation where other than deductors are also filing certain kind of statements. So provision under section 200A was not there to process these kind of returns also, but now they have introduced the applicable provision and it is applicable from 1st of April 2025. So again, time limit, you see earlier the time limit for default in Assessee was 6 years for resident and 7 years for resident, and there was no time limit for non-residents. So now they have bring the parity between all the resident and non-resident, and also the time limit of issuing order is 6 years both for resident as well as for non-resident. And they have also introduced provision whereby through notification they can exempt somebody from the provision of TCS. So again, it's only when a particular notification issued, it should come into picture. Now, as far as late payment of TCS is concerned, if you look at section 2001 capital 1A, the provision is that in case of late payment, the rate of interest is 1.5%. In case of late deduction, the rate of interest is, in case of late payment is 1.5%, and in case of late deduction, it is 1%. So now again, they have bring the parity that in case of late payment of TCS is concerned, the rate of interest shall be 1%, not 1%, it shall be 1.5% only. Yes, it's a very, very, very interesting and very beneficial provisions for all the parents out there. There may be a situation where TCS has been collected in the name of minor, right? So now what they are saying is that that TCS can also be claimed by the parent, and only in the name or in the hands of those parents where that income, that clubbing income of that child has been clubbed, right? So again, it's a very good and beneficial provision. Then 194J, 194C, again, they have introduced a clarificatory amendment in section 194C, whereby they have said that in case of the definition of work, that in case there are certain sums which are covered by 194J, there was a confusion there. So if a particular payment on account of work is covered by 194J, it won't be covered by 194C. It will still be covered by 194J, meaning the higher rate of TDS. So with this, all the changes are covered. Let me go through the point which you have raised, Ridhima. In the meantime, if there are any questions, I can also answer these questions. Give me 2 minutes in that case.
Sure. Deepak, yeah.
Yeah, you're right. It is from 1st of April 2025 rather than 1st of October 2025.
Yeah. So
I stand corrected.
this particular change for 194T is from 1st of April 25.
Right, correct.
Yeah, because we have one YouTube query which was saying that what if the partner
Okay.
resigned on 31st of October or 30th September?
No. So now I can answer that query in light of this change. So can you ask this query again?
Basically, the query was basically what if the partner resigned before the cutoff date of October? But in this case, now I don't think so. There would be a problem, right?
Even if let's say it used to be, let's say if used to be 1st of October 2024, if the partner has already resigned, so on that particular date, whether it is 1st of October or whether it is 1st of April, if it is there is no partner, so there is no question of TDS. There is no question of TDS, because you see the amount which you are paying, it pertains to the amount, it pertains to the period when he was a partner. So we have to see that the amount which is being paid, it is pertaining to the period as a partner and which period, right? So let's say he's not a partner on 1st of April, obviously this provision at all is not applicable at all.
Right. And since we are talking about 194T only, do you think non-resident partners are also included?
Just a sec. It's a very good question. So the provision reads like this: any person being a firm responsible for paying any sum in the nature of partners. I believe it shall also be covered here also, because it doesn't say any
Partners would be
resident
covered.
partner. It shall also be covered.
Non-resident also?
Yes, yes. And obviously in that case, 195 shall not be applicable. 194
Absolutely.
shall be applicable.
Right.
Because 195 is a general provision, and then 194 is a specific provision.
Yeah, because otherwise, when partners' salaries were paid to your non-resident partners, there was no provision for the resident one, but 195 was always there.
Yes, yes.
So now it's all under the umbrella of
You see,
194.
it's a very simple provision. If there is a specific provision, it shall always prevail over the general provision.
Correct.
Because even in case of 195, there are certain payments where 195 is not applicable, even though it's a payment to non-residents. Say, for example, interest. There is a specific
Yeah.
provision for that.
But interest also, 194A did not cover partners'
No,
interest
it doesn't.
specifically.
It doesn't. Because it
So
is
now
not
everything is
you
under
see,
one umbrella.
it is very much clarified. If we look at section 28, it very much clarified that these are the payment which are covered by business and profession, right? You see, salary is not a salary per se,
Correct.
right? There is no
Yes.
there is no employee-employer relationship between a partner and a firm. So that is why I'm saying it's a very interesting provision, 194T.
And I think it was required because there was no check on the source
Correct.
anyway.
Correct.
So it was very much required.
Though I believe 10% is on a harsher side.
Yeah.
It is on a harsher side, but still, let's take it on the positive side of it. Let's take my example. I'm also a partner in my firm. I also take a lot of salary from my firm, right? So till now, you see, my only source of income is from my partnership firm, right? So since till now, there is no TDS on that amount, I had to deposit advance tax from my own pocket, isn't it? And while depositing that advance tax, you see, as generally it so happens that I might have forgotten one installment of my advance tax, and I end up paying an interest to the department. So at least this is a beneficial provision for me. Look at the positive side also. So I know that, okay, I'm going to get X much amount of salary from the firm. So I can make a provision, or I can tell my firm that, okay, that much amount I'm going to take. And obviously that TDS is still lower as far as my liability is concerned. But at least that much of amount I can, save interest. Again, there can be a tax planning there also. Correct. So it's a positive side. There is a positive side to that also. But there may be a situation that you are earning income of only 6 lakh, 7 lakh from the partnership firm, and this is the only income. In that case, obviously, you have to either go for the refund or go for LDC
That is with every TDS provision, rather.
Yes.
And one last question. What do you think why 194F was improved? What was the was removed? What was the rationale behind it?
194T.
FF. Which is for the repurchase of units by the mutual funds from the investors, from the unit holders.
I don't think any amendment in 194F.
I believe it is
194F.
Just one second.
It has been omitted, no?
Yeah.
Acha, omitted. Okay. Again, there is no explanation for this particular provision, if I'm not wrong, right?
Though it is not very prevalent also right now, so we can take it up later. Not a problem.
No problem. Okay.
Great. So I think TDS and TCS is every budget favorite because there has to be some changes always, and there is a clear
TDS
vision
is also
of
one of my favorite topic to speak on.
Mine too, actually mine too. So, but I think government has to rationalize it more because there are close to 100 provisions when we come to TDS, TCS. There's so many. So I think they should rationalize it more with the coming changes in the Finance Act.
You see,
probably in the next year.
Only takeaway from the entire amendment is that even though you have reduced the
rates,
TDS rate, but 190/40, it has a mixed response, right, from both sides, but needs a lot of clarifications, because when I'm taking something from my firm, it may not always in the nature of interest or so and so forth. Even partnership firm may give me a loan, right? So people may also try to justify certain amounts as a loan instead of it is being paid as a salary or so and so. And the another one is the time limit of penalty. It has been straightaway reduced from 1 year to 1 month. I agree. It's not a good move. At least you should have make it in equivalent to the section 139 limit of 9 months. Then we would have understood the issue there. But 1 month,
Correct.
it's not a good thing.
Great. The point taken, definitely. Thank you so much, Deepak, for this insightful session. And I think audience must have definitely benefited from it. Thank you so much.
Thank you, everyone.